Most people lose money in the market, not because they picked bad stocks, but because of when they bought them. There's a strategy that removes timing from the equation entirely. It's called dollar cost averaging, and it's the reason average people beat professional investors over 20 years. Here's what most people do. They wait. They watch the market go up and think, I'll buy when it dips. Then it dips, and they panic and think, what if it drops more? So they wait longer. Then it shoots back up, and they buy at the top, feeling FOMO. Then it crashes, and they sell at a loss. This cycle destroys more wealth than any bad stock pick ever could. Dollar cost averaging breaks that cycle completely. The idea is simple. You invest a fixed amount of money at regular intervals, no matter what the market is doing. Every week, every 2 weeks, every month. You don't check the price first. You just buy. Let me show you exactly how this works with real numbers. Say you invest $100 every month into an S&P 500 index fund. Month 1, the price is $50 per share. You buy 2 shares. Month 2, price drops to $40. You still invest $100. Now you buy 2.5 shares. Month 3, price drops again to $25. You buy 4 shares. Month 4, price recovers to $50. You buy 2 shares again. You invested $400 total. You own 10.5 shares. At $50 per share, that's $525. You're already up $125, even though the price is exactly where it started. Here's what makes DCA so powerful. When prices drop, your fixed investment buys more shares. When prices rise, you buy fewer. You automatically buy more when things are cheap and less when things are expensive. It's the opposite of what human psychology makes you want to do, and that's exactly why it works. Zoom out. What does this look like over 20 years? If you invested $500 per month into the S&P 500 starting in 2004, you would have put in $120,000 of your own money. By 2024, that would be worth approximately $380,000. That's $260,000 in gains on $120,000 invested. No stock picking, no timing the market, no stress, just consistency. The real reason DCA works is psychology. Markets go down, that's guaranteed. The S&P 500 has crashed over 20% more than a dozen times in the last 50 years. Every single time it recovered and hit new highs. DCA means you're already buying during every one of those crashes automatically. You remove the emotion. The dip becomes irrelevant. Setting this up takes about 10 minutes. Step 1. Open a brokerage account. Robinhood, Webull, Fidelity, whatever you use. Step 2. Pick what you're buying. For most people, a total market ETF like VTI or an S&P 500 fund like VOO is the move. Step 3. Set up automatic recurring investments. Robinhood lets you do this weekly or monthly on autopilot. Step 4. Do not touch it. That's the whole strategy. 3 mistakes that kill DCA results. 1. Stopping during a crash. That's the worst time to stop. You're buying cheap. Keep going. 2. Investing money you need soon. DCA is a long game. Only invest money you won't need for at least 3 to 5 years. 3. Picking one volatile stock instead of a diversified fund. DCA on a single stock that goes to zero doesn't recover. Stick to broad market funds unless you know exactly what you're doing. Dollar cost averaging won't make you rich overnight. Nothing will. But it's the strategy that builds real wealth quietly, consistently, over time. Set it up once, let it run. Check back in 10 years. That's paid simple.